Hey gang, so this is part 2 of what is a non-bank loan. And I'll sneak a quick vlog tip in. Make sure you silence or mute your incoming calls. Otherwise, they will interrupt your hopefully wildly compelling first video. So that said, the point I was trying to make before interrupted with a phone call was that we're not bashing the banks. It's a model that works for them. It's just not our model, and it won't be your model either if you don't qualify with them or if they don't want your loan on their books any longer, which we'll cover in a minute. So number 5, to that point, are loans that banks simply no longer want. And I'll give you one example, although there are many reasons why banks no longer want loans. One example is if you begin to start paying that loan slowly. Most banks, and I'll throw another disclaimer out, that there are always the outliers to these, but most banks generally still have, at some level, loan committee. So if you're a loan officer at a community bank and you've got a portfolio of loans to manage, you will have to report on how those loans are performing. And guess what? If you're a day late on that loan, you're on the naughty list. And you're on a non-performing list that you then have to be presented to or presented about by your loan officer. So if you're a community banking commercial loan officer and you've got this portfolio of loans to manage and your borrower is a week late on the payment due to a reason that makes a lot of sense. Maybe it's the same time every year. Maybe it's a slow pay issue with a vendor. Who knows? But if you're a week behind, you're going to end up on a report that he or she will have to talk about. And if you keep ending up on that report month after month after month, they're eventually going to not want to discuss your loan every single month, and they'll look to disposition that off their books. Another example would be within a bank merger. What one bank may deem a great loan at the time is looked at with an entirely different set of eyes post-merger. I've seen it happen. We got 2 leads in this week of unbelievable borrowers, incredible companies, but, and to give you a specific example, the prior bank, the bank that got taken over, based the transaction on global cash flow. The new bank that took over didn't like that at all and said, listen, this one and these 7 others that you did this to, get rid of them, right? We don't want them on the books anymore because that's not how we do business. So that's all part of the give and the take of bank mergers, but that can happen, and that's an example of a loan the bank no longer wants. It doesn't make it a bad loan. It just makes it a loan that that particular bank doesn't want on their books any longer. Number 6, clients who are quote-unquote maxed out with their bank. Once again, it happens all the time. We get monthly leads from our commercial bank partners for otherwise incredible borrowers and companies, but they've just overextended themselves or over-leveraged themselves with their bank. All banks put a safety mechanism in place when they're dealing with a new client or an existing client. And there's a certain number, a certain threshold, and a certain calculation that they do not want to go over, and they feel that it puts the bank at risk in the event of default from the borrower. So if in a new loan request, even though it may be great for your business and great for your company, if the bank feels that that kicks you over into a risk category that is no longer considered acceptable, they will not do the loan. They'll want all the others on their books as long as they're performing. They'll value you as a customer, but they won't want that new loan. And that's where we come in. Because even if you're over-leveraged or you're maxed out or getting there at a couple of different banks, we've always got options because we've got over 40 to pick from. So allow our relationships and our nimbleness as far as being able to select a bank partner for you work to your advantage and not just be limited to your bank, even though they may do a great job on everything else. Number 7, non-prime SBA loans. This is one of our most popular types of loans that we get referred by bankers. Every bank will have an SBA overlay, and most banks around in Boston and the Philadelphia area don't love SBA Express loans, which are lower loan size loans that vary and differ from 7As and 504s. We won't get too into the SBA products, but just know this, that every bank will overlay the SBA to their own liking. So in other words, most banks will look at the SOP from the SBA and will add a FICO minimum, right? Or add a policy as far as placing junior liens on personal assets based on a certain equity position or collateralized position where another bank won't. So just as the reasons for non-bank loans are many, or what makes a bank loan a non-bank loan, just because the reasons for that are many and varied, so are the overlays to SBA. We have capital partners and bank partners that don't overlay the SOP from the SBA. So give you a good example. Technically, the SBA doesn't really have a minimum credit score. Now, most lenders will overlay that with a 650, 660, 675, 700, 720. Those are actual overlays, actual credit minimums with banks that we actively work with and banks that we're competing with. Now, each one of those banks has their strong suits, they have their sweet spots, they have types of loans that they want. But if you're at the 720 bank that requires the minimum FICO of 720 and you're a 680, they're not going to give you an SBA loan. Now, you can spend your entire day finding the bank that'll do a 680, or you can let us do it for you. My point is that banks overlay the minimum FICO score. So if you're a 660, you're going to have a hard time getting an SBA loan most of the time from your bank. So give us an opportunity, because we've got bank partners that will go as low as 600 as far as the minimum FICO. So if you want to call that a non-prime SBA loan or a non-bank SBA loan, you can. Once again, it goes back to the unique property types. If you have a gas station loan and you offer SBA, but you don't offer a 504, you only offer the more costly 7A, that may be a reason for you not to move forward with your bank to give us an opportunity. Number 8, fix and flips or fix and holds. Obviously, there's a whole genre of lenders dedicated to just that space. Your bank is not going to be the best option as far as speed and certainty in the process, pricing, execution, or you being able to do it in an efficient fashion. It's just not their sweet spot. Number 9, loans outside of their region. So if you want to expand, for example, most of the community banks in Massachusetts are limited to Massachusetts and or the surrounding states. If you have a great opportunity for expansion in Ohio, but you still want to deal with someone locally, you're going to be limited because your bank's not going to lend in Ohio. And last but not least, the number 10 non-bank type of loan is product saturation. Banks have algorithms and they have certain numbers that they manage to. So deposit rates, for example, are tied to non-owner occupied properties. If one is out of whack, if you get too much of one product and not enough of another product, they will essentially turn the spigot off or stop lending, essentially, in that particular space. It's a way for them to manage risk. It's a way for them to manage profitability. Once again, it's a great model. It's a successful model unless you're the investor that gets turned down for the loan, or usually it's not a turn down. It's usually a delay in processing. It's a fee hike. It's a rate hike. It's an execution challenge that we don't have. So those are the top 10 non-bank deals. We'll go over each of them in individual videos. Thanks for hanging in there with me. Thanks for hanging in there for part 2. And it is Super Bowl week, so I'm going to keep representing my birds. Even though it's going to be the Patriots or the Rams, still love my birds. Go Eagles. Have a great day. That's all I got.